Good afternoon, everyone. Welcome to the FX Hour. I'm Blake Young here for ShadowTrader.net here every week at the same time, 4:15 Eastern. We're starting a couple of minutes early. Hopefully, no one minds that. We'll get a couple extra minutes in today. Remember, you can follow us on MyTrade. Go to MyTrade, and you can follow all the Shadow Traders. Simply search Shadow Trader, and you'll be able to find all of us there. Follow us there, get our daily updates, calendars, news events, etc., as well as our charts and our setups that we're looking at the moment, and the weekend update, as you can see right down through there at the bottom one. Had a question on how to get access to that one. Simply the same way you'd follow the rest of us, and that's where you get access to it. This is recorded, and it'll be posted to Shadow Trader's website. And you go to shadowtrader.net, look up archives, look up FX Hour, and that's where this will be afterward. My email is fxtrader@shadowtrader.net, fxtrader@shadowtrader.net for any questions or comments that you want to pull into this FX Hour. So, let's get into some of the things that are going on in the market today, and we're going to go into some of the things specifically, as you've already started mentioning, or some of the comments have already started showing, specifically into the things with the yen. But let's start out with the euro US dollar that continues to fall. It's eluded us from our entry point. We tried to get into an entry point here. We tried to put in an order after it tested this high, and what we saw is we saw it tested on a Friday. That was this candle, and we decided we're going to sell at 114.50, and it actually gapped down to 114.47. It literally gapped 3 pips below where we were trying to set up our order entry on that weekend, and we missed that as it went and fell nearly 600 pips. So we've missed that, but we're going to still look for a bounce. We expect a bounce. This is becoming overextended probably a little bit too quickly, and the only way we won't get a bounce is if we have this type of a move. And now the euro US dollar is continuing to slide. We expect that to happen, but we expect some sort of better price. You'll notice on the dollar index that we also watch, the highs that we've had back here, we could be approaching it. We also have a horizontal resistance area right about here that we'll also pay attention to, about 98. So we do expect a stall in the dollar and its advance and how strong it's been, at least as we're watching it right now. So probably not today, tomorrow, but maybe on Wednesday or Thursday. Probably call it Thursday. We should see the dollar test 98.214. That's going to take us back to the highs in April 21st and 22nd. Looking at the euro US dollar for the lows during that same time frame, and you'll see it's going to match very nicely to these support areas. So if we test that level and give a little bounce, great. We'll just look for it to roll over, and any rollover after the bounce could be an opportunity. The move from there to where we're targeting is about 150 pips. So there may be an opportunity in there for that 150 pips, and if you drop it down maybe into a 15-minute candle or a daily candle, you can look for price patterns, you can look for breakouts, you can see this acceleration breakout through here. We are getting a little bit of a bounce after this sell-off, and this sell-off goes back through the morning, right through there. So we broke up through here. We've corrected, shouldn't say sell-off, corrected from the sell-off. And so I would be looking for a short-term bounce at 108.90, maybe 109. And if we can get that 108.90, 109, then we could look for that sell opportunity to sell back through, or a break through 108.62 to get us back down to the 150 pips that we're looking at. Truman, I have a screen that is, oh, I didn't do the charts. Yeah, I got to switch over to the charts. So you're looking at my full screen. This should be broadcasting in a very large sense, but it comes down to resolution. So let me try that again and get it into just the chart. That should fill up your screen, I think, is what you're looking for. Let me just adjust this really quickly. There we go. And now you should be able to see that screen right there. That should be a little bit better, right? All right. Now, one of the big things that we saw is we saw the dollar getting stronger. And remember, what is the dollar, or what else is denominated in dollars? It's not just the euro dollar pair. It's not just the dollar index. But think about what is denominated in dollars. First off, we might look at crude, and we've looked at so many lines on this chart. We've talked about the pullback. So get rid of that one. If I can get it to select it. There we go. And you look at the sell-off that's gone on. This is the lowest point that crude has been. Lowest shadow, lowest close. closes at 58.28. We had a close back here at 58.27, so we could get the lowest close. We actually bounced up a little bit, but we did push to the lowest point that it's been at all the way back to April 29th. So we're talking about almost a whole month after breaking out through this key level of 59. This is the lowest point we've been at since that time frame. And so as the dollar is looking to get stronger, remember the April 21st time frame that we just talked about with the euro. As we look at the April 21st time frame, that would be down here, and we're talking about a push back down to 56.18. Now, a push down to 56.18 should see the Canadian dollar continue to weaken, and that strength in the dollar will continue to pull this down unless we have some shocking new thing happen in crude. We know that the last 3 days have been able to sell off, even though we have numbers that showed there was a little bit higher demand, and even though there's been attacks on oil rigs. So the crude light has fallen more driven by oil, or the dollar getting stronger than what we've seen in the others. So crude is down at this point, and we'd expect the dollar Canadian to continue to move higher. Now this is one of our other trades that we have open, and we're very, very close to hitting our target. We just got to get a little bit higher, and then we should be able to see it hit our target in the near term. And we were looking at a breakout, Fibonacci breakout trade that looks something like this. So we're up above that 161. We're going to be moving our stop into break even and higher, actually profitable territory, and we'll look for it to get up into this 125 area as Canadian dollar loses ground to the US dollar, as the dollar is getting stronger and Canadian dollar is getting weaker with falling crude prices. And especially if it gets below 55, then we should easily get above this previous resistance and support area that we had back through here and be able to get back and retest the highs. Now it's not just here. Now this is going to tie this back in money into your Aussie yen trade, but it's not just here. Look at the Aussie yen, or the dollar yen. Dollar yen just broke out to a new high. We paused yesterday, we broke out. Did anybody read this? Watch this? Know what happened here? I think this is very intriguing. And it's something we should be all paying attention to. If this would have happened last week, I would have put this in the weekend update as the things you should give a pip about. First off, notice that we anchored our Fibonacci reverse anchoring technique. We broke out through here, we rallied up, and now we've hit that upper target. And now, next move, if you're looking at the long-term channel, is 124.86, if not up to 128.24. Let's go back even further to the weeklies. You can see this monstrous trend off of the sell-off. And part of the reason why I had the profit charts up is we can get more time on the yen. See how far back we can go here. There we go. Not quite back into the Asian contagion, but this is post-Asian contagion right here. We went from this 78 area all the way up to 147. Notice how fast we did that. And I wish we could show that. I might have to pull up the profit charts to do it. But we did that in a matter of approximately 39 months. Call it 3 years. So in 3 years time frame, the dollar yen rallied 6,000 pips. That is 75% of the value of the yen was lost in that 3-year time frame. Now, if we're looking at a similar situation, it's actually almost 3.5 years, but if we're looking at a similar situation through here, we have already moved 4,000 pips, and we're about at the 3 years. So if we continue moving and saw that same kind of 6,000 pip move, and we continued moving, we're going to get back up into these areas. We could pause here and where we erase those candles, and I would look for that to pause there. It's not quite the same thing yet. But the news that came out today could be that situation. So here's 6,100, roughly where I'd expect that target to move. We had 3 months that opened or closed at this level, 4 months. And as we're looking at that 139 leaves us with 1,600 pips to move in just over the time frame that we saw the previous move during the Asian contagion. Why would I compare this to the Asian contagion? Because the Bank of Japan came out and said, what we are doing doesn't work. Now that is what everybody has been watching, the Eurozone, the US. Everybody that's done any type of quantitative easing, anyone that's put to a 0% interest rate, anyone that's gone into a negative interest rate, anyone that has played the game of quantitative easing has paid very close attention to the Japanese experiment. And the Japanese experiment is, how long can we have a 0% rate? How long can we try to spend our way out of troubles? Well, now for 20 years, we've been dealing with a 0 per 20 plus years, about 22 now. We've been dealing with a 0% interest rate out of the Bank of Japan. And now they're saying, oh, you know what, it's not working. Well, easily we could get back up into these areas. The only thing that will make a difference is if they suddenly change their tune and change their approach, and the Japanese yen is strengthened, or they sell back some of those bonds and buy back their yen, and that would really strengthen the yen. But right now, that still puts the yen's trajectory up into that 131, 140, 145, all the way up into those 147 potentially, but I'd be looking probably 140 as we're looking at the dollar yen rise. Now, this is a significant move. Now, this is a significant, scary thing. However, didn't mean to do that. Let me get rid of those. Come on, stop it. There we go. This is a significant and scary statement, and the move itself is a solid breakout. So the first near-term move, we'd expect it to get up to 128.24. We missed the breakout. We'll watch for a pullback, some sort of pullback and pause as it climbs. The Aussie yen, which you pointed out, isn't moving. So this move is almost purely the difference between the dollar and the yen. The yen lost a lot of ground today, but didn't lose hardly any ground against the Aussie yen. Remember that the Aussie yen is our substitute to greed and fear, which can oftentimes tell us how the market's going to behave in equities. So here the Aussie yen is struggling to move higher, toying with the previous resistance area, and stalling. Remember, we're looking for key reversal points, not necessarily whether it's up or down on one day or if it's at the same highs and lows. As we see the Aussie yen is struggling, equities get clobbered. We can't break through resistance on the Aussie yen. Is breaking, as Money points out, it's testing the 200-day simple moving average, which is a significant barrier for it. And equities get clobbered today, and equities sell off, and equities drop 31-point range, falling back into these areas. Now we've had similar days. This was 30.25. We come back here, and that was about 37. So we've had similar days that have reversed in short order, and we know that we have a number of earnings coming out. But this is fearful when we see that the Aussie yen cannot move higher in spite of the yen being sold off, in spite of the Bank of Japan saying our methodology is not working. It wasn't enough to turn this thing up after a bounce. It's failing. That greed and fear trade is showing there is not enough greed to push it higher. Even though there may be enough fear, there's not enough greed to push it higher. So the greed and fear are kind of balanced out on the Aussie yen, but we're doing that at a key resistance area. And so struggling at that key resistance area and looking back again to the S&P, that's a major sell-off. So the sell-off is falling back below previous resistance. We've talked about this being overextended. Looking at the Dow, same game, same rollover at key resistance. And oh, by the way, it's past Memorial Day. For anyone that likes rhymey type sayings, the sell in May and go away is in play. This may be the sell-off for the beginning of the summer, and if we see that, we could break through here. Now, I still wouldn't be too scared of maybe a huge sell-off, but I wouldn't be surprised to see it come back and test the 17.5 and go sideways the rest of the summer. As we look at the NASDAQ, I mean, big earnings could change that, but NASDAQ rolling over at resistance. Now, the fact that we couldn't make a new higher high makes me pay very close attention to the low in between. So if it breaks through this low in between, then the NASDAQ has set up for a double top, and that double top is approximately 3.4%. So even if it corrects that whole distance and duplicates that double top, we're looking at close to 6.8% drop, which is going to talk about 42.13, maybe in that area right through there. So that sell-off could break out and the NASDAQ could continue to fall. And let's look at the Russell, because the Russell tends to sell off quicker when we get a little more fearful and we step away from higher risk. And then Russell is actually not even setting up for a double top. It's setting up for lower highs and lower lows. This is the true trend reversal. And so any trade below this point would be lower highs and lower lows Dow theory, and we'd be looking at a downtrend. And remember, so Jazz, back to the beginning when you're talking about the Euro-US dollar, I'm not looking for the Euro-US dollar to go up. I'm looking for the sell-off to take a breather. Everything has to breathe out. Right? Everything has to breathe in. So when markets take off really quickly, like the Russell did through here, even if the trend is going to continue, I expect it to breathe out. So the Euro US dollar fell a little bit too quickly off of its highs and hasn't given us a little pause, hasn't given us the bounce, hasn't given us what I would consider a true lower high and lower low. I mean, unless we count one candle, and I just don't think that we can, to get us back into a solid downtrend. So we created kind of a funny double bottom, definitely higher lows, higher highs as we came up through here. For this to be a downtrend, I've got to bounce. I've got to have some sort of pullback of the downtrend. So I expect it to continue to go lower. I really do expect bearishness in the Euro US dollar. They're doing quantitative easing. We're now being told, hey, guess what? It doesn't work. Everybody that was watching, doesn't work. Stop it. All you Keynesians, all I can say is, ha! So as we're looking at this and we're looking at the move down, I want to see lower highs and I want to see this continue to go lower. So I'm just looking for a lower cost, cheaper entry. That's all I'm talking about. You know, and so I'm just, the dollar I expect to be strong. I just expect a temporary pullback. I'll have to see if I can find that news report money. It was not. You have to read the actual report, and I'll have to see if I can find it, because it was a lot of double talking, definitely. I actually had a student a couple of years ago, when we saw the beginning of the crash in 2008, 2009, that came and told me, said, you know, there's one thing you told me this year, or in 2008, that I've always remembered. You said this will be the biggest exchange of money, biggest exchange of wealth from one group to another since the Depression. And we really have seen that. We have seen a major shift in who has the money from 2008, the crash, till now. And a lot of that is because of quantitative easing. Those that are sitting on cash and don't use that leverage have seen their purchasing power decrease. We've seen oil prices hit record highs. We've seen such big swings. Money has moved around, and we know that it's shifted, and we know that it's changed. We've seen banks collapse. We've seen big insurance companies collapse, and we've seen others get unbelievably rich. If you don't believe me, go look at Monaco. There's a reason why it costs $1.5 million for a 1,000 square foot studio apartment. So, you know, we have seen a major shift in money. So as we're looking at those things, this is a major shift in money, and that quantitative easing, it doesn't work long term. The U.S., the fact that they're ahead of the game is because they stopped. They ran, I think, too long, and I think we still have to pay the piper at some point. But Japan's been doing it for over 2 decades. But I think that does diminish the expectations for those that are still planning on doing it. So that's really kind of where I'm coming back to, is that should diminish that expectation of this helping out. That means maybe the euro is going to weaken faster. Hang on just 1 second, I'm reading the chats here. We got a lot of chats. Alright, so let me see where I'm at. Talked about that, talked about the Eurozone. How do you correlate the futures? How do you correlate everything to Apple? Sudden, first off, this is Forex. So generally, I'm not a fan of talking about Apple, to be very honest with you. I will pull it in occasionally. But simply put, it used to be that the NASDAQ was what we'd compare everything to the Apple. And then as they were added into the Dow, I'd say the Dow and NASDAQ are probably a good combination of things that you would expect. So there's such a large component of both of them. We expect to see whatever is happening in the NASDAQ and the Dow should also be happening here. And you see that is the case. We put nearly equal highs, just like we did the NASDAQ, just like we did the Dow. And you can see that similar move through here. equal highs, rolling down, big sell-off. And so if the NASDAQ is going to fall back to its low midpoint, and the Dow is doing the same thing, I'm looking at the Dow futures, and you could use the DIA for ETFs or the QQQ for the NASDAQ ETFs, or you can use other indexes, but I'm using the futures here. The idea is we should be falling back to this support area, if not down to 1752, so we're looking at April 3rd or May 5th on the Dow, and that should give us a very similar view on Apple, which puts Apple back down to 125. Now that's not too big of a drop for Apple. It just looks very scary with such a large bearish engulfing candle here. And it's done it before and pulled back before, so that's where I'd be putting Apple. I'd be putting Apple to come back and test 125, and then I'd watch carefully, watch the NASDAQ and the Dow to see if they break through support. If they break through support, then the Apple should break through support, and it should fall down here. And I'm very deliberately calling it the Apple because I like it, and I like the same way I'd approach it with the Walmart. So. And like I said, when the Bank of Japan says that quantitative easing doesn't work, guess what? That's a problem. And Orange Crush, like I said, it's ironic that if you go back, a lot of people have quoted this before, but if you go back, most people will point to John Maynard Keynes as the originator of this comment, which is ironic because the comment is the market can stay irrational longer than you can stay solvent. And that is true even if you're a central bank. The market can stay irrational, the economy can stay irrational longer than you can stay solvent. So the idea of spending your way out of debt, or spending your way out of a recession, well, we can be irrational longer than they can be solvent. And we see that with the Bank of Japan. They have struggled with it and they cannot pull it together after 22 years. Like I said, I'll find the report here in just a minute. And I'm also not a big Elliott wavist, but I just think there is definitely room for the dollar. I'm just focusing on the near term. So near term, I expect a pause, a bounce down here at 98. If this has been your corrective wave, if you're starting a new wave and you're going to do Elliott wave counting, great. But I would be looking at the way I would approach it. I would be looking at previous support through here that was broken, acting as resistance up here near 10. Call it 100, 102, but it's going to take some time to get there. I would even look at this potentially as a Andrews pitchfork as we look at that low, that high, and look at this pullback right through there, and maybe remove that one and say, yep, that's where I'd be looking. I'd be looking for it to repeat this pattern here, but potentially up here at 102. It could clear the highs, but I'm not, right now I do expect it to pause, a bounce down. I'm just looking for the short-term target, bounce down, so we can have an opportunity to re-enter a dollar long position. I hate chasing the bus. Like I've said before in other sessions, chasing the bus, just like when you're in junior high or in elementary school, if you chase the bus, what always happens? You miss the bus, your friends point at you and laugh, you go home and ask mom for a ride to school. That's the way it works. And so chasing the bus, I'm not a fan because the risk associated with chasing the bus is greater than the potential reward, especially if it stops at a previous barrier. So I'm, again, on the dollar, on the euro dollar. I'm not saying the dollar is not going higher. I'm not saying the euro dollar is going to be strong. I'm expecting a pullback. That's all I'm getting at. I'm looking at a better price. I just want to get a better price on this thing and then go with it. And the trend is up for the dollar and the trend is down for the euro US dollar. Do I think the 35-year bull run is in bonds ending? Stevie, that's, from the words of iRobot, that detective is the right question. Because as we're watching this, when we look at these huge runs, yes, we have major corrections. I think the corrections have kept it from having, this is the bond futures, but I think these corrections through here have kept it from being overly crazy, and that I think these have disrupted the bullish bond run enough when you're looking at the price action corrections, enough when you're seeing it pull up back 18%, enough right through here 16%, and even if we fall back and just retest the trend support through here, we're still only talking about 20 to 30%. Those corrections are probably big enough that it kept it from being a scary, super extended bullish trend. Now, I understand why people say that. I understand why people look at it and call it a 30-year bullish. I can't go back far enough on these, but I understand why they look at it that way. The reason why I say that is a good question is because if we're saying now the quantitative easing doesn't work, and if we're saying the Bank of Japan has failed on the Japanese experiment, does that weaken the status of central bank debt? Does that weaken the status of sovereign debt? Does that weaken the status of the U.S. bonds? And the first answer is, yeah, maybe so. Maybe the goodwill, the faith, the expectation does cause it to fall back even further. The other side of that coin is, wait, we're not doing quantitative easing right now. In fact, we're talking about raising payments, raising interest rates. And so those that have an interest rate, those that offer an interest rate, I think will still be in demand as both a safety compared to others and a yield, a low risk or no risk, what is considered no risk, which I disagree with, but a no risk yield. And so right now, again, on the bonds, I think we could fall back. And if we fall back to 145, what does that support? What is the support? What if we fall back to 137 over the next 2 months, 3 months, a year? That supports higher interest rates or higher yields. Look at the ZN during that same time frame. So we look at the ZN. You can see it's pulled back. It is creating lower highs. And we have a low point through here. To get into lower highs and lower lows in the downtrend, we've got to break through here. We haven't broken through there. We haven't had what I'd consider a downtrend with lower highs and lower lows since 2004 to 2007. So since the recession, since the crash, we haven't had lower highs and lower lows theoretically on the 10-year treasuries. And this does, and I know Slim disagrees with this, but this does impact, I believe, the housing market. And so here's the lower highs and lower lows. Here's this big downtrend for treasury yields. And so if we look at the 10-year treasury yields, and if we break through this high, then we do create higher highs and higher lows. And after we create higher highs and higher lows, this move, just this move right through here, would see a 1.37% move. 1.37 would put this up to, wait, I measured that wrong. Let me try that again. 13.87, excuse me, would put us up here, right back up to these support areas previous to 2007, and that means our interest rates or yields from the 10-year treasury would be 4.41%. Call it 4.5. And if we're at 4.5, then the 30-year home mortgages, because the 7 years and 10 years are really what 7-year auction really determines the mortgage rates. As I've said before, add 175 to that, and we're talking about 6.25% rate. That sounds really high compared to currently. Sounds normal for real life. But that does put us on track in the next, measure the time frame that it took to form this, call it a double bottom. Then by the time it breaks out, we are talking about 53, 60 months. So in the next 5 years, I know it's way out there, we should be in the sixes, which is healthy, which is normal. And that's what I would expect. So, but that would slow down the home builders. As you look at home builders, we had this lovely little trend through here. Notice huge recovery in 09, 010, or 010, 09, 10, 11, 12, 13, we stopped. In 2013 to 2015, we have netted about 16%, 15 to 16% over 2+ years. That is 7% a year. We're slowing. We haven't topped out. We haven't reversed. But we have created lower highs. And if rates go up, I do think you will see a pinch. And then we'll create lower highs and lower lows, and then possibly a breakdown through here. The markets have to breathe out. As we've already talked about oil, let's talk about gold. And you can look at the sell-off in gold, and the gold broke through our trend line today. So as far as closes go, we cleared it. This is a sell-off. As we look at the shadows, we're almost there. So if you want that little extra confirmation, then a break through this trend line will also be a close through these lower closes, and that would confirm a swing low. And that swing low I would look for is right back into 1150. With the dollar being as strong as it is, just like on the others, let's watch for a small bounce. Let's watch for a lower high in here. Let's watch for gold to come back up and test 1200, roll over at 1200, break the trend line, and fall back to 1150 by mid-June. And that is probably when we're going to see all the euro dollar bounce off of a temporary bounce and gold down, the dollar bounce off a temporary support and go up, and that's what we're looking for. Okay. I love my mother. Why would I not say my mother? She took me when I missed the bus. I didn't like my friend from pointing and laughing. That wasn't very nice. Yep, Mike, you're right. And I agree with that. You know, the fact is, what do we see? Market Piper has to be paid at some point, one way or the other. Manipulation aside, and we know that right now they're being scrutinized, so we know there's probably going to be a lot less manipulation, at least in the near term. You know, the market can, Jazz, you're right. The market can't yields, falling bond prices, rising yields. The market can oftentimes lead the government. If we see that there's more yields coming out of other instruments, that can oftentimes precede monetary policy. So if we can see that, if we can get that move, how sweet it is, because then we see that continue to move. Now, what's going on? We haven't done this yet. I'm trying to keep up on top of all your questions. But let's go back into the trade tab. Let me share the desktop, or just the main part, so we can do our analysis of where's Waldo, where's the Fed, where's the Fed sitting. So I'm coming back to gold contracts. I'm changing this to ZQ. ZQ is the 30-day Fed Fund futures. And a reminder, I say this every time, but just want to be clear, when we see the 30-day Fed Fund futures move, what we're looking for is we're looking for 100 minus this number. And we're looking for this to get to at least 0.25%. If it gets to 0.25%, we know we have a rate hike. If it gets higher than that, we could have more of a rate hike. Right now, we're quote-unquote between 0.25%. So that's this nebulous floating target. So as soon as we see this get to a solid 0.25, you can see it's between 0.25. It's halfway. So as soon as we see this get to a solid 0.25, or in other words 99.75, then we know we have a rate hike being priced in by the markets. We have a high probability for September. We're most of the way there. Of the 0.25 move, we can see at 0.795, but if you want to know when the lock is, you can see that is October. October is still the lock. Nothing has changed over the last 4 weeks. We are still seeing October as that time frame. So yes, it can precede it. Yes, we can see other rates going higher. Yes, we can see companies offering a higher rate. But remember, they're going to also determine their rate based on what they're seeing in the market. And so that's some of the things we'd watch. So let's look at where the next rate hike is just quickly. Not in October, not in November, not in December. We're looking for 99.5. So sometime between February and March. The lock is at March at this point. That's what's being priced in. Let's go back to the charts. I have to switch over which type of chart I'm showing, because otherwise you don't see it. There we go. We talked about the dollar CAD rallying. We talked about that on oil price moves. Just to quickly hit that again, we're looking to get up to just above 125 for our price target. We talked about the euro US dollar, and I know some of you are asking about this because you came in late. Euro US dollar has sold off. We're still looking for a bounce higher, but then a sell off. We want to sell this off in a continuation down. Notice the Fibonacci retracement off the low to the high currently. We broke through the 61%. That's a big deal. On the way down, I wouldn't be surprised and I'd be happy with an opportunity to sell near 110.95. I just don't know if we're going to get in a big enough bounce to do that. So I'm going to be looking closer to 110 for a potential sell-off, or bounce and then sell-off, excuse me. Bounce and then sell-off. So yeah, and WX, like I said, I have no problem with Elliott Wave. It's just not something I follow, so I'm glad it fits kind of in with what you're doing. Yeah, sudden, I think you do see a stop in mortgages and real estate and home builders. And I know some people say, no, it has nothing to do with it. It's about bigger economic moves. So, all right. That's not doom for gold money. That's just a fallback to support. Well, and you got to remember as well, if interest rates are higher, people will start looking at, is it worth the risk of equities to trade in those equities for 8% or 10% if you can get 6% in the open market in what would be a low risk or no risk, and that's in quotes, a no risk or low risk opportunity in fixed income. Yeah, and Mike, you're right. There's nothing really supporting the Feds or the equities at this point. And historically, by the way, historically, people always talk about bonds and equities going opposite. They don't. In the short term, on the daily charts, even on the weekly charts, they tend to. But when you look over years, 5 years, 10 years, bonds, prices, and equities move together. You want to look at a shorter time frame on the ZB. So on the ZB, first off, let's get rid of this gap, because this looks like this lovely consolidation at previous support. To get rid of the gap, we're going to put in the Septembers now, because before we'd put in the Junes. And the September, and I cannot remember, September is U5. So we'll put in the ZB-U5. That gets rid of our gap. We could do the M5 if you want to still see what that looks like, since this is just doesn't have as much data. But you can see where old support was. That's a pretty sizable bounce. Nice recovery in bonds today. Short term, like I said, they move opposite of equity. Long term, they move together. Short term, they're opposite. Long term, they're together. So as you see right now, bonds are up. Bond prices are up today, and I'd say toying with this previous resistance through here and our 38% fib that we did off the lower highs. So probably a temporary bounce, and then we'd look for it to continue lower. And again, if you want to see just the September time frame, you go to ZBU5 and you see the ZBU5 toying with the same resistance area right through here. Just looking through, and like I said, I wouldn't sit, as I was saying, money, I'd put it out at least 5 years before we saw 6% rates. And that's pure technical. That isn't even getting into anything else, any other monetary policy, any other manipulation, any shock and awe, any war, any change in commodity prices. I'm just talking about technicals only. On the treasuries, I would still give it 5 years. Would I repeat the part about gold prices? So gold prices, what we talked. Oops, wrong one. Not GX, GC. Gold prices. This is the gold future. Probably don't need to see a 15-minute chart. What we talked about here is this was a sell-off right to this support area. We broke through the closes. You can see we have touch the shadows here. We kind of came down and tested that horizontal support. That I wasn't going to be surprised to see a temporary bounce, maybe a retest near 1200. And then if we break through 1180 after testing 1200, I would expect to swing down to 1150. Just to swing low back to strong support. Let's see. Yeah, Mike, I think right now, with all the negative data and news we keep getting in the U.S. and across the world, I think they will continue to kick the can down the street. Right now, it's market is still pricing in for September. The problem, Stevie, with a trying to orchestrate a 20% market correction, which they haven't had more than about 3 to 5% market correction, in all this time frame. The problem is, how long does a bull market usually last? And this is what is a little bit concerning to me, is if a bull market generally lasts 6 years, 5 to 6 years, we're already at it. We're already past it. We're overdue for a greater than 10% correction. If they do raise rates as we go into September, well, we know that the market's probably going to trade relatively flat or slightly bearish if we look back at history for the summer months. So maybe flat. We know that traders come back in September. If they're coming back in September, or traders and institutions get more involved in that time frame, at that point, if that's when the Fed steps in, it could cause a push on the brakes. Jazz, on gold, I'm probably only looking at next week. Let's call it almost exactly next week, Tuesday or Wednesday next week. Let's look for a test of 1200. Maybe out to the 16th if it goes sideways like it did through here. That could, I kind of like that too. So either over the next 1 week, 5 trading days, or let's look for a high at 617. And we'll be able to look at that next Tuesday as well. And we'll look for that test there. As long as I have internet connection next week, then we'll look at that next week. If not, I think I might be having Peter sub in for me next week. And then I'd look for the rollover. Does everybody has everyone here been trading long enough to remember when we were raising rates? Do you remember when it was? I remember. And then when we started cutting rates, it magically coincided with Greenspan leaving office. So Greenspan raised some rates, and then topped out, and then, because the irrational exuberance, remember that phraseology? That's when we were raising rates, and we're doing it consistently and methodically. And then he stepped out right as the house of cards was about to fall. Bernanke had to pick that up. He set it up, got the quantitative easing going, and left. So maybe Janet Yellen is getting ready to handle the next collapse or next bubble burst, whatever you want to call it. All right. Right. Yep. I agree with you, WX. The fact is, this one was orchestrated, so it can behave differently. But I definitely agree with that. I mean, everything that I ever learned in economics, and the many, many economics classes I took, the more manipulation you take to try to slow down the extremes, the more extreme the next move comes. Over and over and over and over. He raised the rates only a couple times, I think once, twice, and then stopped it out and then started going into reverse. Is that the, yep, there we go. Yeah, so in 2002, you had the gold or Greenspan years. finishing up. Have Bernanke step in. He does one or two, I think two more quarter point rate hikes. Then he tops out, stops raising, then he starts into the reverse because they went too far. That happens over and over and over again. So let's look at some of these other pairs. We already talked about the euro. Let's hit the pound US dollar. We'll hit some of these exciting ones. Pound US dollar breaking through the key support, broke through our trend line. This is a breakout. My next target on the pound US dollar would be to fall all the way back down to 151.15. Now that is about 270 pips. Again, I'd like to see another bounce and a lower high, so my risk is lower for that next move. There's an opportunity in there. But maybe even more there than it would be also to watch for this pound New Zealand. We've talked about this one before, that when it sets up into a trend, no matter what the trend is, you can see over and over and over again, what happens is it'll trend. It'll create higher highs and higher lows, and you can anchor a trend line off those generally. When it breaks through, you set up another lower high, and away it goes down. When it breaks through, it sets up a higher low and takes off. When it breaks through, it sets up a lower high and falls again. And you can see these trends don't only end, but they really extend into the next trend. They're really great reversal points when they do end. And so you can see these trends doing what they've done. This one is probably one of the more extreme ones we've seen in years. So the pound New Zealand ran all the way up here. To break through that, the question is, which way are we going to go on this? Are we going to look at this off the closes, so it's something more like this? If so, off of that close and these closes through here, then we'd be looking for a break as soon as 121.08 or 21086, and then we'd be looking at a new downtrend that could easily come back to 202, even down to 194. Those moves are talking about thousands and thousands of pips, significant moves on the pound New Zealand when they do break out. It has a history of doing that. The New Zealand dollar, the reason why we're not seeing that is the New Zealand dollar is also losing faster than the pound. And you can see the move that we had. This is the most significant breakout we've had in months. And looking at these moves and these breakout opportunities, this move was an attempted rally. We've sold off, and now we've broken through the downside. The New Zealand dollar could fall all the way down to 67 cents. To look back historically, when we've last been at 67 cents on the New Zealand dollar, we've got to go back before the crash. Oh, even further. I thought we could do it in 10 years. Evidently we can. There we go. It's in 09 now. Why didn't that show up? I think it must not have been zoomed out. I was thinking that it should have been in 10 years. This key support area near 67 is the bounce in the recovery of 2009. Notice it wasn't just the bounce in the recovery. It was previous support prior to the crash, and resistance. So this 67.90, call it 68, is a key level of support for the New Zealand US dollar. We just broke out in the multi-month pattern, Fibonacci pattern, or price pattern, however you want to look at it. This channel is broken out, and we should see 68 on the New Zealand dollar. That means more weakness for the New Zealand dollar. Looking at the pound, until the pound sells off more than that, then we're not expecting that pound New Zealand to break down. So you can see the pound is struggling at this resistance, but we've got to get down through these lows. I'd say you've got to get through 145.40 before we really saw that pound New Zealand reverse. But this is a key point for the New Zealand dollar. And the New Zealand dollar, you can see, is still falling. Agriculture prices all the way back through this time frame. The agriculture prices hitting new lows as we're watching the dollar get stronger. And the lowest close we've had on DBA, Deutsche Bank's Agricultural Fund, going back as far back as that Deutsche Bank's Agricultural Fund has gone. Looking at corn prices and corn futures, you can see it's breaking through a key support. Let's watch for corn to fall back to 340, if not 320. Looking at wheat, all tying to the New Zealand dollar again. Huge sell-off, monstrous breakdown, very significant, one of the largest sell-offs we've had in months. And so I would be looking for the wheat futures to come back down to 466. Major sell-off and a lot of bearish pressure that we're seeing in wheat. One of the things that does help the New Zealand dollar from completely collapsing is the fact that cattle has not fallen apart yet. You know, Jazz, is the price of oil a big factor in the price of the pound? Historically, BP is attributed 10% to their GDP. Now, they get to pull oil out for a lot cheaper than Canada, so that's why it's not hitting them as hard. So when oil prices are at 56 and 58 and 60, they're still making money. Oil out of the North Sea is not $55 a barrel oil. I think it's in the 20s or $30. And so they do pretty well. Still, they have margin when it's at 55 and 60, where Canada's margin dries up to about 55. And so that's why it's not as significant as an impact right now to the pound as it is Canada. So the frackers and the Canadians are getting smacked around with low oil prices if they stay down below 55. But, Orange, you bring up a good point. When oil prices are down, if energy prices are down, usually solar struggles too. So you'll notice, look at this chart. Falling down, sideways, sideways, sideways. It breaks up through this near-term resistance right through here. This is Solar City. And then trade sideways. Does that look like anything that you would see as, I don't know, crude? Falls down, trades sideways, breaks up, and flatlines about the same time, April. End of April. So until crude decides which direction it's going to go, if crude falls back below 55, then solar companies, solar stocks, I would expect to struggle as well. And as commodity prices are low, and as we're looking at gold falling, then we'd expect the Australian dollar to fall, and the Australian dollar is falling and breaking down and struggling and cleared resistance and is falling. Hasn't broke through the annual low, but then again, gold still has a move to swing low. It looks very much like gold. Rally is too high, pulls back, looks to be setting up to swing low to that low. Just like we look at 1200, I'd be looking at about 78.21. So pull back on the Aussie dollar to 78.21, roll over, and then sell off down to 75.88. And if gold is falling, if Australia is falling, remember again, that still ties to equities, giving us a bigger pullback. So Carl, with the weakness of the Canadian dollar last week, are they going to be justified in that? This weakness in the Canadian dollar here is not necessarily meaning more supply. So this weakness is market-based weakness, not monetary policy weakness. And so the monetary policy weakness, cutting rates and making it cheaper, is theoretically meant to stimulate the Canadian economy. So if they do cut rates, the goal is to put more money into their market, more availability and borrowing. And so I don't think the rate or the strengthening of the US dollar and the weakening of the Canadian dollar really has much impact on whether they'll raise rates as much as it will with their economic reports and their economy. So if we see their economy is continuing to struggle, then I would expect them to raise rates, or cut rates, excuse me, not raise rate, cut rates. Now they're at 0.75. They could easily go to 0.5. They have room to move. It's not quantitative easing until they get past 0. So they have something to work with right now. All right. That's kind of what I'm looking for. Let's see. We hit the Canadian. We haven't hit the Swiss. Let's talk about the Swiss. There's your shock and awe, depeg, but now we have normal price action. And as we watch this, is there a trend in there? So we look at the closes and the shadows. We broke through there. You notice we can anchor a pretty decent channel off of that, off of the lower highs and lower lows. So now that we've broken above that and broken above the horizontal level that we've looked at before, multiple touch horizontal level, the dollar is gaining strength. And so I would expect the dollar Swiss to rally up to where it's going to intersect with both this trend line and horizontal resistance. And so it probably is not going to move too aggressively, too quickly, and it might still come back and bounce a little bit, but I'd be pushing this out to maybe a week from now, maybe next Thursday, where we'd see the dollar Swiss come back up to 97.28. That's going to break through a horizontal resistance, and if we break the second channel in a downtrend, then we're all out bullish, and that will be breaking through resistance as well. You want to talk about coffee? Let's talk about coffee. Coffee talk. Pretty much the same as corn, pretty much the same as wheat. pretty much the same as agriculture prices, except we sold off earlier. So coffee broke out, and by the way, DBA, I think it's 13% or 11% of DBA is actually coffee prices. So when we looked at the Deutsche Bank's agriculture fund, that we already saw that happening. So what you can expect, this is kind of a fun one, when the coffee prices are breaking down, going lower, does Starbucks lower their price? When's the last time Starbucks lowered their price? When's the last time McDonald's lowered their price? Or 7-Eleven? Or Dunkin' Donuts? Or whatever your favorite coffee is. So when we see a correction in price of nearly half, what does that mean? I know this has nothing to do with what we're talking about as far as equities or commodities, currencies, other than the agriculture prices are falling and it should continue to see the New Zealand dollar weaken. But this theoretically is an opportunity with low prices, half the price of before, as Yogi says, more profits. And so we might expect to see bigger margins on Starbucks. And the only reason why we wouldn't expect that is if we had the economy really shift and people stopped buying coffee or slowed their coffee purchases. But as you can see, ta-da! Exactly what we said, right? As coffee prices have fallen, the Starbucks keeps going. We peaked out here in October, middle of October, and so we probably bottomed out about the same time. Oh, what do you know? Within one day, we did the same bottoming out. And as long as coffee is breaking down, that might be able to sustain Starbucks higher. Now, coffee broke down today. It's not necessarily on a one-day bias, but it is on a longer time frame. They've still got their inventories and everything else. See how it all connects? Everything connects. I've talked about solar and coffee and Starbucks and Dunkin' Donuts. We've talked about the Bank of Japan and quantitative easing. We've talked about cattle and corn and wheat and home builders and interest rates. They all connect. You cannot trade in a vacuum. There's too much information to be had, and there's too many things that we can pay attention to. Don't try to trade in a vacuum. No vacuum trading. All right. We hit the Swiss, Australian, New Zealand, pound, euro. I think we've hit all of them. I think we've hit all the pairs. So we haven't talked natty gas. Let's go throw natty gas there. Nature abhors a vacuum. I agree with that. Natty gas looks a lot like the others, but here's the interesting thing. Natty gas has already broke through the previous resistance area. The substitute is already down through here. This could be a pretty good indication of demand. Demand is falling. So oil prices have struggled. We don't have a substitute. And it's summertime. Who uses natural gas in the summertime? Who would use natural gas in their cars when you can get cheap oil prices? Well, those that have natural gas cars. Look at copper. Copper selling off. Copper breaking through our trend. There is another trend through here that we might want to pay attention to. And it's right off these highs that we could look at. And maybe that's what... No, we're breaking through too, even on the shadows. So copper looks pretty bearish at this point. We'd look for copper to potentially fall back to 267. Remember, copper is my favorite go-to as far as global demand and growth. And this is not a real positive sign as it breaks through its trends. It's not in a downtrend yet, not a strong downtrend, but I'd be looking for a swing low back down to 268. If it breaks 268 or creates a lower high and then breaks 268, now we're talking about back into a downtrend, possibly back into a recession. And we've talked about the yen and the VIX, but the move in the yen is not necessarily because of this. We have higher volatility, but we also have the Bank of Japan saying we're not doing well. And so at that point, the higher volatility is being offset by the weakness of the yen triggered by the Bank of Japan. Normally, they would move together. And one more time back to equities. I've already commented that I thought that we'd be bearish back down to maybe the swing support right through here, 2041. I think you're right, though. If we clear that, that's an easy target back down to here. In fact, this is a channel. it'd be a funny looking double top, and then that puts us right back on track to 1970. So really close to your Elliott wave analysis, right? Lower highs and lower lows and a breakout down to that level right through there where we had previous support and resistance. But we have to break through here. Right now, this bearishness is on the cusp. I'd like to see it break the trend. It hasn't really broke the trend. Big sell-off. But if you look at the higher low closes, certainly haven't done that. We just tested it. I'd like to see it break this trend before I really expect a long-term downtrend. Otherwise, we're just looking at a retest. As we look at that, let's look at EWZ. Brasileiro. iShares for Brazil, not doing well. You can see it tends to run in this pattern pretty well. Just duplicating my line. So there's a breakout. And that's, I'd expect to swing low at this point. Yeah. Yeah, and that's, and I know you're right in agreement with me on that one. I know the Elliott wave isn't as precise as a support and resistance level, which is what I'm watching, so I certainly understand. There could be some white swan events coming soon that will send the market soaring, or the opposite, right? Frankly, I think we've seen all the black swan events, all the unexpected we've seen. Right now, I think the market's just now trying to price in what's really going on. And then as soon as we decide that, we can see where we're going next. Muito bem. All right, let's wrap this up. We are out of time, so thank you for being here. Next week I should be here. Well, I should be able to broadcast remotely. If I do not have a strong enough internet connection, Peter will be subbing in. I'll be talking to Peter here shortly to make sure that we are covered for that. But if I don't talk to you next week, we'll talk to you the week after. Let's hopefully talk next week. This is recorded again. We'll post it to shadowtrader.net under archives under FX Hour. Email again is fxtrader@shadowtrader.net. Have a great week, everybody, and we'll talk to you again really soon.